Throughout the month of December, U.S. two-year Treasury yields have consolidated in a tight range between 4.4 on the upside and 4.15 on the downside. Now, this represents the tightest monthly range since rates began to head higher in earnest in early October of 2021. The relative lack of volatility appears to be a product of a cross-current of economic data, beginning with the CPI and the retail sales numbers coming in lower than expected versus GDP, housing starts, consumer confidence, and personal income all coming in higher than expected. Perhaps the biggest global economic story remains the rocky reopening of the Chinese economy. While global markets are welcoming the reopening, there is significant trepidation regarding the pandemic numbers over the next few months. The market now has to wait until January 6th to get the next major data point, which is non-farm payroll reports. Now, many analysts are closely watching the labor market with the belief that the Fed will need to see some slack before they begin to signal a pause in rate hikes. Now, if a trader believes that rates could head higher from here, they could express that by buying the January micro two-year Treasury yield futures contract at 4.29 and targeting a move back to the November highs of 4.70. A stop for this trade could be placed below at 3.95. Now, this trade could make $410 if the target is reached and risks $340 if you're stopped out of your level. Now, if a trader believes that rates could head lower from here, they could sell the January micro two-year Treasury yield futures contract at 4.29 and target a move back to the psychological level of 4.00. A stop for this trade could be placed above at 4.40. This trade could make $290 if the target is reached and risks $110 if you're stopped out of your level.